Uneducated Economist here. So thank you all for joining in on today's live stream. We got 16 people who have already joined in and 12 likes. Thank you so much for hitting that like button when you join in on this live stream. By hitting that like button, the YouTube algorithm will pick up the video and spread it around for more people to join in. And it's always better to have more people joining in on the comment section. It makes these videos a lot more interesting. Now, today we're going to be talking about how it is that the Federal Reserve and their adjustment of interest rates is impacting the economy, or actually moving in a way that is opposite of what it is that most people would have thought when the Federal Reserve goes to cut rates. Now, if you have been following me on this channel and we think about the credible threat theory, all this stuff makes sense. But most of the people who are studying the economy or talking about the economy or, believing that they know something about what's going on within the economy would have it much differently off of the belief would have it much differently in their thinking when the Federal Reserve goes to cut rates, that would lower the mortgage rates. Now, what did we see happen? Since the Federal Reserve made their interest rate cuts on the Fed funds level, we've seen mortgage rates move up. Mortgage applications have fallen. There is less home sales taking place during a time in which that people thought for sure it would spark activity within the market, within the housing market, quite opposite of what we would normally see. So now, if we understand the credible threat theory, then it all starts to make a lot more sense. And the idea that with the idea that the Fed rates and the Fed cutting of interest rates has less of an impact on the economy, outside of more of the belief of it has more impact on the economy. Now, we can see this, evidence of this, when we think back to just a year ago. Mortgage rates peaked out back in October, at the end of October of 2023. And in November, there was talks of interest rate cuts in a grand magnitude. Like there was going to be a bunch of them. The dot plot map, the Fed prediction of where interest rates are going to be going into the future, had predicted that there was going to be several rate cuts taking place in 2024. Like everybody was under this impression. What ended up taking place was activity within the mortgage market that actually lowered rates. We saw them move down from almost 8% all the way down to close to 6% before the Federal Reserve did anything at all. The Fed hadn't moved, and we saw this huge reduction in mortgage rates taking place, all based off of the anticipation of what it was that was coming in 2024. Then what ended up happening? The Fed did lower rates. They lowered them in an extreme fashion. And since they lowered those rates, the Fed funds rate, which had everybody anticipating that there was going to be less mortgage rates, right? The mortgage rates were going to come down, it had quite the opposite effect. The market got very spooked by the idea, and that the Federal Reserve lowering rates was somehow indicating that there was trouble within the economy. And the exact opposite started to take place within the housing market, within the mortgage market, within interest rates in general. We saw the U.S. Treasury yield starting to rise. Mortgage rates were rising. The dollar index was rising. All things completely opposite of what it is that people had anticipated from the Fed's move. Now, once you understand the credible threat theory, it all makes sense, because understanding the credible threat theory takes you all the way back to the great financial crisis when the Federal Reserve lowered the Fed funds rate to zero. That essentially destroyed monetary policy. But most people don't know it. And because they don't know it, they are still focused in on the Fed rate adjustments as the main monetary policy tool. It is not. It is their words. And you can see the evidence of it just by the idea of the mortgage rates coming down all of this last year, since October of 2023 till now. We saw mortgage rates coming down dramatically, but yet the Fed did nothing. They sat on their hands the entire time. Let the markets do the work for them by putting out the narrative that they were going to be lowering rates going into the future. People anticipated that lowering of rates and started acting accordingly to what it is that the Federal Reserve was looking to do. See, I wonder what would have happened to mortgage rates had the Federal Reserve continued with a wait and see. If they did not lower rates by a half a percentage point, right, by 50 basis points, if they did not do that at the last meeting and instead said, hey, we are most likely going to be cutting at some point in the future once the data is indicating that we should do that, and the data is showing that we should be cutting soon, what would have happened to the market's perception? Would it have continued to lower the mortgage rates off of the idea of the Federal Reserve dropping rates before they did anything? Just the simple idea of it, because that's what it took to lower mortgage rates for the last year, was the belief that the Federal Reserve was going to be cutting rates. But the moment that they actually did it, the exact opposite took place. All the people who were sitting, oh no, I'm going to wait. I'm going to wait to get a better mortgage rate once the Federal Reserve starts to lower the Fed funds rate. I'm going to be able to buy a house and then refinance into the future with cheaper rates. That did not take place. The exact opposite has taken place. We're seeing a slowdown happening during a time in which that most people would have seen the Federal Reserve's actions as stimulative. But it's not. It's acting restrictive. Like the evidence of it taking place is showing restriction within the economy, not stimulation. Right? Stimulation would be lower interest rates. It'd be cheaper loans. But we're not seeing cheaper loans. We're seeing more expensive loans. We're seeing less refinancing taking place. We're seeing less new applications happening. That is a slowdown taking place within the housing market. That is essentially the crash. A lot of people are waiting for prices to come down to indicate the housing market crash. But that's not it. It's the lack of transactions. And the fact that the Federal Reserve lowered rates and it caused the exact opposite to take place within the mortgage rates is showing that the Federal Reserve does not have the capabilities of adjusting monetary policy through the rate adjustments. It's all through the belief of it. It's all through their words. It's the anticipation of it coming. And that has so much more impact on the economy, and there's so much evidence of it now playing out. However, most people won't be able to see it if they're not aware of the credible threat theory to begin with, and how it is that the monetary policy hitting the lower bound of zero essentially destroyed the Federal Reserve's ability to adjust monetary policy through that rate adjustment. That's what we end up finding today. All right, let's go and get some of these questions going here. Thank you so much. We got 191 people watching with 63 likes. Keep hitting that like button, everybody. All right, All Nighter says, got my haze out of the way, back to work with me, but I'll be listening the ear candy. Well, thank you so much, All Nighter, for being here. All right, moving down, we got, hi everyone, happy work day from Sacramento. Well, thank you, Mark, for being here. Glad to finally make one of these live streams. Slap the like button, y'all. Yeah, thank you, Nick. I appreciate that. All right, hit the like, people. All right, keep doing it, guys. I'm loving it. All right, is a 2008-like crash coming or worse? No, I believe that a 2008 crash does not even come close to what it is that we are experiencing today. What we are experiencing today is something far different. See, the '08 crash had something very different going on. There was a huge overbuild happening. People were trying to take advantage of the increasing prices. However, the problem that most people were facing at the time is that they were getting loans for homes that they should never have received. Right? There were no job verification, no proof of income, getting these loans, right? These ninja loans, right? No income job association or whatever, or accountability. You had people who had many mortgages out there still able to acquire a home. These were toxic mortgages. They were never going to be able to get paid, ever, right? And that's the problem that was being faced within the housing debacle at the time, is that the Fed knew it, right? They knew it at the time. They didn't want to admit it, because if they did, that would have actually crashed the system. So they had to deploy the idea that it was a subprime problem and that they had it, isolated to that. They knew they didn't. They knew that there was going to be a crash in the economy and that they would have to take interest rates to zero and go into massive asset purchases, the quantitative easing programs. They knew about that way ahead of time. Like, we have covered it on the speech called Deflation and How to Prevent It from Ever Occurring. Ben Bernanke knew that moment was coming, right? Now, even though they knew it was coming, I don't believe at the time they had the regulations set in place to prevent the toxic mortgages from being issued. Now they have that incorporated, saying, no, like, you got to make sure that these people have the income, that they meet the certain qualifications, that the down payments, all this other stuff. There's these higher criterias in order to acquire the mortgage to buy the home. Back in the day, that wasn't existing. So all these mortgages were created for homes that were never going to get paid. And they were creating mortgages way above what the value of the house would have been. So between that, it created the housing market debacle that the moment that these mortgages or a downturn in the market started to take place and the payments weren't going through, then you had a complete crash of the system. All these mortgages, these mortgage-backed securities started going toxic because what was filled with them was a bunch of crap. Today, we don't have that same issue taking place. However, there is a much bigger issue that I believe is taking place within the markets, and that is the lack of transactions. Right there, that simple statement, the lack of transactions. If you have a lack of transactions going on within the housing market, whether it's due to the anticipation of lower rates or the rates are just too high and they can't afford them, no matter what way you think about it, it's the lack of transactions that are happening or that not happening that is preventing the housing market from actually moving in a way that would then bring more inventory and more sales and more capabilities of people in order to buy into the market. If it's slow, then you're not going to have builders excited about bringing new inventory in. If interest rates are elevated, people who are sitting in low interest rates are not going to want to give up those low interest rates to flip their house into another dwelling, knowing that they're going to be paying a higher interest rate for, so they're going to sit tight. This is preventing there from being new inventory or a better inventory of homes that would then bring more buyers to the market, considering the competition would most likely have brought housing prices down. Like, this is a very common narrative to be brought out there, but there's no new inventory coming to the market in a significant way. You can see this through permit issuance or the lack of permit issuance, the lack of new starts. These are all coming down from their peaks during the pandemic when everybody was moving from the city out to the suburbs. There were a lot of demand for new construction, remodels, new places to live. This was very prevalent during that time. So there were a lot of permit issuance and a lot of new housing starts that were happening. Well, that's falling. In fact, it's down to the point that we were at pre-pandemic. Now, if you think about it, pre-pandemic level might be kind of like a good sign, saying, hey, if we were doing just as much as we were doing before the pandemic. The only problem being is that we were coming off of historically low housing starts and permit issuance. And unless that rises substantially, you're not going to make up for the lack of production that was taking place for the last decade or more. See, this is the problem that we're facing. Everybody says, oh, no, man, all these people are going to get out of their houses. They're going to be... Okay, that's a great story to tell. But if you look at the evidence of what is taking place right now, that is not the case. People are sitting tight. There is a lack of inventory. There is a lack of new builds starting up. There is lower interest rates than there were before, but there's less mortgages taking place right now, or less new issuance taking place, considering the Federal Reserve had done lowered rates to try and spark activity within the economy, or at least that will be the belief of it, but that's not what's taking place. It's quite the opposite of it. Understanding that signal, the markets, the lowering of rates, that signal to the markets that there is bad times ahead, or else they wouldn't have done such a jumbo rate cut. Normally it would have been a quarter point. But they did a half a point. And everybody went, oh my God, they must be anticipating a recession or something. And they started backing off. They were like, oh no, I'm going to hoard my money. I'm going to ask for a higher interest rate if you want my cash for the next 10 years. And you can see that happening within the U.S. 10-year treasuries. See, the U.S. 10-year treasury is like the indicator of where all interest rates go. Mortgages, credit cards, car loans, it doesn't matter. You follow the U.S. 10-year treasury and what direction that is moving, that's where interest rates go. The Fed, their lowering or adjustment of interest rates doesn't work. Most people don't know that, right? Most people believe that is the main policy tool because that's what they indicate, that's what the mainstream media indicates, that's what all economists who have been studying the Fed, that's what they believe. However, if you understand the credible threat theory, you're going to know that the Federal Reserve and the adjustment of monetary policy through the interest rates, through the Fed funds rate, is not the tool. It's their communication about it. All right, moving on. We got a $2 super chat. Let's go check that thing out. Don't kill me, I'm just a vibe. $2. Thank you so much. I love the name. All right. Is there a time frame for this crash? Well, what do you mean by the crash? Like, to me, this is a crash. If you can't go out there and buy a home, then that's a crash, right? I mean, that's like, essentially, it's a crash in transactions. It may not be a crash in price. A lot of people are waiting for a crash in pricing. They say, no, when the price comes down, that's the housing market crash. I don't believe that. I believe it is much differently now, and I believe that it has to do from the lack of transactions. And because of that lack of transactions, you're going to have a lack of builds. And if you have a lack of builds, you're going to have a lack of inventory. And if you have a lack of inventory, you're going to have elevated prices, which is going to prevent people from being able to get into a home. And if that's the case, that's a crashing housing market for you. You can't get in. Right? People are thinking that they can get in during a crash. That is not the case. The reason why the typical crash of prices does not allow people to come in because the banks are not loaning. And unless you happen to have the cash on hand, you're not going to be able to get into a house at those cheaper prices. And then we look at the people who are using all cash purchases. There is more now than there has been since the 80s. Like, there is more cash purchases of homes taking place now than there has been in decades. Decades and decades. Well, you think about it. If there was a crash in prices, who would be buying homes? People with cash. Well, they got more people buying in cash today. What does that signal? Right. See, like, people are thinking, no, it's the price. Don't think about the price. Think about all the other evidence that is happening. The lack of sales, right? And the cash buyers. That's the crashing housing market. And people just don't recognize it because they want to see lower prices. That's what they want to see for a housing market crash. But that's not going to be the case. I mean, you might find some places lowering prices. You might even find them lowering prices significantly. But are you going to be returning back to what it was 4 or 5 years ago? Probably not. Considering that there has been almost an exponential rise in prices over the last couple of years, just because they backed off a little ways does not mean that they have returned to normal or what normal would be. Right now, what we have as far as the economy in the United States is a massive separation between the rich and the poor, and there's no better evidence of it than the property values, the rents and leases that people pay. When you see that the property owners are separating themselves from all the rest of the people out there, there is no better evidence of it than finding that there is cash buyers buying in at this price level, considering that the interest rates do not impact those cash purchases. They are willing to buy at this price. See, I think that everybody's kind of expectations of what a crash would look like has confused them on what it is that they are anticipating coming to the economy that would then give them that view of a crashing housing market. Nobody believes that there is a crashing housing market taking place today. But if you look at the transaction, crashing housing market, right? It's the lack of transactions, the lack of build. Right? Could you pay your yearly property taxes with one gold coin? Easily. Easily. In fact, I don't know if I could do 2 years, but I could certainly do one. All right. Can Chuck Norris drop his towel like Arnold Palmer? Okay. Screws down here to the bottom. Alrighty, Charger Mopar. As soon as any assets fall in value, the Fed will go burr. I don't believe it. I mean, you can... What is it that caused the increase of asset prices, but not that of inflation? All right. See, now a lot of people would go back to the quantitative easing 1, 2, 3, and 4 after the great financial crisis. We watch asset prices move up, but yet we saw the inflationary scenario stay stagnant. Did not increase in the way that the Federal Reserve had anticipated. They were looking for a 2% target during that time, failed to even achieve it. They got it a couple of times, got over it a little bit. For the most part, quantitative easing 1, 2, 3, and 4 failed to produce the inflationary scenario that they were looking for. So now I think about it. What is it that the Federal Reserve is doing that actually starts to stimulate the economy. All right? I mean, is it the money printer that does it? Well, if that was the case, you would have seen inflationary aspects of it coming from the great financial crisis, but that didn't happen. See, what they ended up doing is loading these big banks up with reserves. Those reserves do not impact inflation unless they are actually borrowed into existence and start buying assets. That's why we see the asset prices moving up, is because people who had first access to the money, they were able to go in and buy into these assets with that new money. But people weren't borrowing that new money to buy toothpaste. Right? They weren't buying it to, or borrowing that money to, you know, I mean, some people might do it to go and get, like, you know, some of their increase in their standard of livings, but for the most part, people earn that money. And they borrow money to buy cars, and borrow money to buy stocks, and they borrow money to buy bonds, and they borrow money to buy all this other stuff that you start seeing moving up. So if the Federal Reserve was to look at those particular assets and say that, oh man, if these things fall, we're going to have to fire up the printing presses again, then what ends up happening is that people will borrow that money and they will separate themselves from the rich from the poor. I don't know if that's necessarily the desire coming from not only the monetary policy coming from the Fed, which is going to make it more difficult to operate in, or if the future monetary policy is going to say, we need to inject money into this system so that we can produce a consumer. See, before, lowering interest rates would get people out there borrowing money to go buy houses and cars and go on vacation, but they're not going to do that if the interest rates are not going to stimulate the economy. Right? They lower the rates and they still can't get people to go out there and borrow the money. They're in debt saturation. How do they produce a consumer? They literally have to inject money right into it, right into the people's pockets. And then what is it that they are going to decide to do with that money? See, this is where I think that most people who are stuck on the idea of UBI or something of that nature has some sort of idea that this is going to elevate their standard of living by having this UBI coming in, this universal basic income. But the people who get that universal basic income do not behave in a way that is going to benefit their life going into the future. Generally, they're going to spend that money in a way that separates them from the rich, makes them even further away, makes the inequality grow. See, when people get that new money in, the UBI, they're like, oh man, you wouldn't believe on how much easier it is to pay rent and buy food and pay the electric bill and all the other stuff that goes with it. It'd be like, yeah, man, that makes it a lot easier for you to deal with when it comes to purchasing those things. Are you paying off your debt with it? Are you investing that to the future? No. I mean, if that's not the case, then what's going to end up happening is that money's going to flow right to the rich, and it's going to separate you from the poor, or separate you even more. And that's what ends up happening when any attempt to try and bring new money into the system. So even if the asset prices were to come down, like you're saying, and the Federal Reserve was to fire it up, they know that that is going to create a situation that will return the prices back to the assets, but it will also cause the inequality to grow even more. This is a problem. They are speaking about this now. This is one of the reasons why you're finding so much talk about UBI and the idea of stimulus packages being on a regular basis to try and bring a better way of life to the people. And it has this assumption that that's what's going to take place. But understanding the economics of it, understanding monetary history, and understanding that when you bring in new money, you will have an inequality that takes place, there's no way that it's not going to happen. The only way that you can prevent that from taking place is to literally back off, to just say, hey, we're not participating in anything at all. The Federal Reserve sitting on their hands and letting the balance sheet unwind all by itself. They don't have to do anything. If they take zero action at all, the problem would start to fix itself. The pain that people would experience would be far more than what they would be willing to tolerate. And they would beg the administration to do something about it, that they actually have to do something about it. And when they do something about it, the problem gets worse. All right. Let's check out this super chat from A2 Grub, $5. Thank you so much. Is this part of the real or fake economy after 2008 housing crash. Real or fake economy? To me, that doesn't make sense. There is no real or fake economy. I mean, unless you just don't understand what it is that's taking place, and then you're bouncing all over, then you don't know if you're dealing with something real or just something fake, then I can understand that part of it. But to me, there is nothing fake. Like, I don't have any fakery going on inside of my view. Like, I understand other people will be like, no, look at all this manipulation taking place. To me, that's not fakery. Like, I understand it, I see it, I'm conducting myself in a way that says, hey, I need to protect myself from this. But there's no, to me, it's not a fake economy or a real economy. Every single day, I have to participate in real life. So there is no fake economy. There is only the reality of the situation and how it is that you conduct yourself inside of that. Thank you so much for the $5 too. I appreciate you, man. All right. I have never had debt. Well, good for you, Charger Mopar, man. I wish I could say that. I've paid a lot of debt. All right. Andrew K, I am sure it will come back around. I don't buy into all of the gloom and doom. The question is how long. Toilet paper does not take the smell away. Rocket, I don't think you've understood. All right. Let's cruise down here a little ways. All right, something professional. Got here late. Did I miss anything? Nah, we're just talking about housing market stuff. Talking about OnlyFans, guys. I'm telling you, OnlyFans. All right. 90% of sales are completed by 10% of agents. All right. How's business, UE? The lumber business is slow. It is slow right now, and it is pretty obvious how slow it is when you can see that the lumber futures price is so dramatically down comparatively to what it is that I would feel have been taking place considering the tight inventory levels. I mean, this is something that we have gone over quite a bit. The mill curtailments, inventory depletions, the shutdowns that have happened over the last year are very prevalent within the economy right now, within the markets. I can see it through, like, you go to place orders for lumber, and usually it's pretty easy. You just call up, you say, hey, I need these kind of units, I need this stuff. There's an availability out there. Sometimes prices fluctuate, depending on what the demand is at the time. And you see that fluctuation and you're kind of used to it. What I am not used to is seeing low prices and then you call up to order something. They say, I'm sorry, I just don't have it. Like, that to me is like, that's a huge obscurity within the market. Normally, if you call and you say, hey, this is not available, the price of it is going to be through the roof because of the demand for it's being so high. But the lack of demand is also preventing there from being a significant supply. And between these two, we have a very, very tight, low-priced, low-demand market that is just primed for a skyrocketing in lumber futures if there was any uptick in demand, which we are not seeing. We are not seeing it yet. There could come a time in the future in which we do. If mortgage rates were to actually come down, not off of the perceived idea that the Federal Reserve is cutting rates and going to lower mortgages, not talking that, I'm talking the reality of the situation where mortgage rates do come down in a significant fashion, much like we had experienced over the last year. If that comes down to a point in which that people say, yes, I am now encouraged to buy a house, you will see the builders wanting to take advantage of these high prices. There is not a lot of production within the market right now when it comes to new builds. And if you see that start to ramp up, there is not enough inventory in the market, you're going to see the prices go up. But it takes that condition. It takes that condition to take place. People have told me, dude, you've been preaching the same thing for over a year. We still haven't seen these prices move up. And I keep trying to say it's due to the builders' sentiment. Once those buyers come to the market and the builders recognize that and they see that the buyers are there, they will want to build. At this point, why would you build a product that nobody wants to buy or that less people are willing to buy? Less mortgages being taken out to buy that product. Would you be encouraged to build a house? Would you invest your time, effort, money into something that is not going to be in high demand? Of course not. You would back off and wait for the demand to be there. It doesn't matter if the prices are elevated if you can't sell it. People said that all the time, man, ripping people off with the high lumber prices. When I was selling 2x4s at $13.50 a piece, which would normally go for around $4, but we had them priced at $13.50. People are like, man, you greedy bastards, you're taking advantage of it, you're screwing the people over. Do you know how many 2x4s I was actually selling at that price? Very few. Nobody was buying at that high price. Same thing that's happening now. The high prices of homes and the lack of buyers out there it doesn't bring for a very active participating market. And that is damaging to the rest of the builders, to the rest of the suppliers, to everybody who's like trying to participate in this thing. That is the crashing housing market. People just want to see it in prices. It's not in prices, it's in transactions. Alrighty, guys, what time is it? Alright, I'm going to give it like another 5 minutes and then we're going to call it quits here. Very slow here in Georgia with all trades. Yeah, and I'm seeing it. I have people who I've known for years, my entire life, who have been in construction in this community, coming to me and saying, hey, if you know anybody who has any framing jobs, I need some work. Like, they're looking for projects out there to go to work at, when before it was projects coming to them, right? And now they're not finding that as prevalent here. All right, great work on your math skills. All right, when is the crash coming? We need to reset already. And I keep trying to explain it. It's the lack of transactions. That is the crash. This is what we're experiencing right now. People want to see it in prices. Now, I'm not trying to be offensive or anything, but your ego is calling it out as price drops. Don't let your ego control you. Don't let your ego tell you this is what it has to look like in order for it to be a crash. This is where I think a lot of people end up making the mistake. They say, no, it needs to pencil out just like this and it needs to look like this in order for it to be what I believe it is. And that is the crash in prices. Until then, we don't have a crashing economy. But I'm looking at it saying, no, there's a lack of transactions happening right now. The separation between the rich and the poor is growing even more. That is the crashing economy. People just don't recognize it. They recognize it as crashing in prices, that all the asset prices coming down, the stock market coming down, housing market coming down. That's what they believe is the crashing economy. They don't look at it as the lack of transactions, which is the real crashing economy. All right. Can't expect a drunk nation driving a tonk at 2 a.m. not to crash. All right, Trump finally back to being the funny troll we love. I don't know. I haven't listened to it for a while. Trade weed for bike parts, Gresham area. Okay. If I'm going to cause it, then I won't have any problem remembering I said it. I will make Simon beg the Fed to cut rates to zero watch. All right. Very interested perspective, transactions, pretty intuitive. Well, thank you very much. I mean, well, here's the thing. Like, I work in the market. Like, I am in it. I'm a supplier of lumber. Now, granted, I am in a very unique area out here in the Pacific Northwest, on the coast, the small community. What I see here is going to be very different from what has taken place throughout the rest of the economy, throughout the rest of the country out there. Now, that being said, it does give me the ability to look out there and say, inventory has huge gaps. I know people who work in the supply industry, whether it's loggers and mill operators, truck drivers, and when I hear these people communicating in a way that says, man, things are slow, we are not doing as much business as we were. When I think about this as a whole, right, I think, okay, this is a lack of production. I mean, you can give it all the reasons and excuses and everything else that goes with it, but what I am looking at is a lack of production, a lack of activity. When you have a lack of activity, how could you possibly have a product that comes from that? You can't, right? The products that do come from this are going to be very few, considering how little activity is actually happening out there. So if you have such little activity that has taken place, think about what has happened in the past when you have had a crashing economy. A lack of transactions, right? That's the problem. People want to see it in a particular way. I want to see it with prices coming down. I want to see it with like looking like this particular thing, but not realizing that that is their own beliefs, their own ego that is telling them it has to be like this in order for it to occur. But once you recognize, you say, well, wait a minute. During a crashing economy, we have a lack of transactions, a lack of production. You got a lack of, things that are happening. And then you look out there right now and you say, hey, these are similar things that are happening right now, even though the prices are still elevated. Right? You can't call it like, you go over and you send troops over to go do a policing action. And they go and they fight, and there's people who are dying and getting blown up and stuff like that. And you're like, man, you guys are at war. It's like, no. It's not a war. This is a police action happening here. And it was just like, okay, you sent troops over to a foreign land, you're fighting, right? And that is a war, but it's not a war if you don't call it that. Like, that doesn't make any sense, right? So it's just all on what you call it. People are saying, no, this isn't a crashing economy. A crashing economy would have the stock market coming down and the housing market coming down and all this other stuff. And I'm thinking, no, a crashing economy is the lack of activity. That's the crashing economy, and that's what we're experiencing today. Alrighty, guys, I got to call it quits. Uneducated Economist. I got a $5 super chat. I got to read that first. Hold on. Don't kill me. I'm just a vibe. $5 again. Are no transactions an indication of the credit crunch or liquidity crisis we witness the bank or the failure of a bank? Yes, I agree. That is very similar. Now, we would anticipate it looking very differently than what it is. But consider the idea that the Federal Reserve is trying to figure out a way that they could keep the banks liquid, like they have access to liquidity coming in the future. Like, the Federal Reserve right now is actively trying to figure out a way that they can continue to provide liquidity to these banks without actually going into some kind of like program, right? Like a quantitative easing or something of that nature. And now the only reason why they would be trying or strategizing on how to do this is if there is going to be a lack of loans, a lack of transactions, a lack of banking activity happening out there. There would be no other reason for the Federal Reserve to be figuring out a way to then try and bring this liquidity to the banking system. Mainly, they're going to do this through the discount window, which was their main operations when they were first, established back in 1913. It eventually took on a stigma because the banks were abusing this discount window. They're trying to bring this discount window back to the banking system in a way that doesn't have the stigma attached to it, and gives them the ability to keep the liquidity flow into these banks without actually going into like a program, right? So to me, that is evidence of it happening right now. Gosh, guys, I would really love to continue on with this conversation. I think it's a really good one. Let's keep it going. Hit that like button. Come back to the video after we upload it, and we'll continue this conversation on Uneducated Economist. You guys let me know.